Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Good everyone, welcome to the show. Pleasure that you can join us as we navigate this crazy world of property investment. And it is crazy at the moment. Lots going on, depending which paper you pick up or what podcast you listen to or what website you look at. The impression would be there's blood on the streets and everyone's going to blow their dough and the Australian economy is going to fall to pieces and the bank's going to collapse and because property values are going to decrease by up to 40%. So it's what some segments of the media are talking about. Whether or not there's any truth in that, I'm not too sure. A lot of this stuff gets sort of fabricated and sensationalism sort of sells papers. So it is a time of flux, it's a time of uncertainty, but there is some underlying fundamentals which is shaping the market at the moment. It is a market in flux. A lot of it is driven by bank policy, to be fair. If you've been tuning into the Smart Property Investment Show for some time, you would have heard quite a lot about our analysis of the borrowing environment. A lot of it driven upwards of over 2 years ago with APRA, who's the prudential regulator, making changes to how banks lend money. So a lot of it's been sort of curbing interest-only lending money to investors. They make it a lot harder for investors to get money these days. The purpose of that was to try and slow down the market and I think the mistake made was thinking that Australia is one market, so property was overheating all over the place. A lot of those policy decisions were based to try and take the heat out of the Sydney and the Melbourne markets, and that has taken place now. So a lot of it policy driven, and it's going to continue over time. Some lenders are looking to beef up their loan books, so there is some reasonable deals going around right now, but these policy decisions are going to stay in place for quite some time. But I wanted to deep dive into that today and actually understand the status quo, the state of play on how investors are getting money right now and how it might impact how they can go about creating wealth over time. Before we do that, just a real quick plug. We're relaunching the Smart Property Investment website. So just a heads up, go and check it out. It's probably in a week or so. There'll be a new whiz-bang website which we've been working on for quite some time, which is drawing out all the best of smartpropertyinvestment.com.au over the years and what's been really popular and really understanding. We've done a lot of work on understanding how and why people are connecting with it and what information is important to them. So we've got some great new features coming in there, but it's still supported by a really good sort of data engineers. You can do whatever research you want. And importantly, a lot of it's driven by the Smart Property Investment Show. That's got a big feature. So go and check it out. It's coming. We'll let you know if you're not subscribing to our daily morning market newsletter, smartpropertyinvestment.com.au/subscribe. You'll be the first to know when it is launched and really appreciate your feedback on that. But moving on, let's chat about money. Let's chat about finance. Let's chat about how you can best position yourself to capitalize on this market flux. And my view is that if you're prepared and ready and you're poised to capitalize, there's going to be some good market opportunities coming up. And that might be 6, 12 months, 18 months away in Sydney and Melbourne. But I'm getting ready and I've been working with my broker to make sure that I'm prepared. Today, I've asked Marissa Schultz into the studio. She's a high-performing mortgage broker that also works across some other areas of financial services. She's won a whole heap of awards, too many to mention, but she's going to help me have this money chat, this money talk. Marissa's also a property investor, and we'll touch on that really quickly as well. But Marissa, welcome to the show. How are you going?
Yeah, really good. Thanks for having me, Phil.
What's your view on this state of the property market or the financing market? Is it just the new norm or this is something which is completely unique?
Yeah, well, I think your introduction was spot on. You know, there will be a lot of great opportunities for particular investors moving forward if you get yourself into a position to be able to capitalise on those opportunities. But certainly because of the Royal Commission and the APRA review, you know, we have seen a lot of changes to lending policy over the last 12 months. And it is possible that we're going to continue to see some further changes and some further tightening over the next 6 to 12 months before we reach a new level of normality. At that point, you know, we might see some things come back. But at this stage, you know, borrowers really need to be aware of what is going on. And, you know, there is a real variance between policies amongst the different lenders. So definitely having a broker on your side that really understands this space and really taking control of it yourself. You know, it's something that you really need to be, you know, actioning and really be proactive about managing your finances.
So to my point in that sort of probably long-winded introduction I made, but trying to paint a picture, intervention by the regulatory bodies to shape the way in which lenders give money to property investors has had an impact on the market, but the impact on the market is not the basic fundamentals of why property markets should go up or down or left or right or whatever. It's policy driven, right? Policy has changed property markets in Sydney and Melbourne. That's a fair statement. Yeah,
look, I think that is a fair statement, but I also think that, like you said, it is supply and demand that will ultimately impact the property market moving forward. And I think, what the regulators are trying to do, won't necessarily have the impact that they're actually wanting to have. But, I think that Australian property market is still well placed to continue moving forward and growing in the future. So I'm not concerned about what impact that the policy changes will have. It's just a matter of making sure that you protect yourself against them. And it's important to note that the policy changes at the moment aren't just affecting investors, but they're also affecting people that want to buy their own homes. So we just need to be across that. But I think, long term, it's not going to really have a big impact on what's going to happen with our property market values.
I guess talking about supply and demand in real simple terms, and to simplify this, and I like to keep things simple, there is less people in the market buying or trading in property because it's harder to get money.
Yeah, I think at the moment that would be fair.
So why is it harder to get money at the moment?
Look, there's a number of changes that have been made and it's mainly around responsible lending. So I guess, one of the biggest ones that we're seeing at the moment is a real focus by all lenders on living expenses. So traditionally, borrowers haven't really had to have a good grasp on their living expenses. We've had the household expenditure method, the HEM, which have traditionally given us a baseline for what living expenses will be for a certain sized family. Now moving forward, lenders are asking for a detailed declaration of the living expenses of borrowers. And that can be tricky because not all borrowers actually understand their living expenses, which is part of the problem. But not only are they asking for a declaration of living expenses, but they're actually verifying that. So they're looking at credit card statements and bank statements to actually question whether what they've declared is fair and reasonable. So I think more than ever, it's a great opportunity for everyone, whether you're a home buyer or whether you're a property investor, to really actually look at what you're spending. Really actually analyse where your cash is going and really have a good understanding of that and see where you can cut back. Because being able to demonstrate a lower living expense for your family will ultimately be an advantage to you moving forward. If you can demonstrate a lower living expense, you will be able to increase your borrowing capacity. Whereas if your living expense is higher than normal, then that is going to have a detrimental effect on your borrowing capacity moving forward.
So why have the banks changed the way they assess living expenses? Before they used to go, it's about this, so we'll assess you on what is deemed to be normal or average. But now they deep dive into financial transactions and actually see how much you spend on takeaways or what you spend at the pub or whatever you do. So they deep dive in it. Why are they doing that?
Yeah, I think it is largely driven by the Royal Commission. And the Royal Commission is basically wanting to ensure that lenders are lending responsibly and that lenders are ensuring that they're taking into consideration everything that's going on for that particular borrower rather than just giving them generalised numbers to their application, what is actually happening for them. So I guess that's where it's being driven from, and the regulators are wanting to make sure that, we are in a low interest rate environment right now. Interest rates will inevitably go up in the future, and they're wanting to make sure that banks aren't lending to people that will not be able to afford the loans, when interest rates rise. So I think that's where it's coming from. I think that living expenses is one of those things that's here to stay. So whilst there might be some areas that might sort of soften, I think that,
that's
there is...
That's a new norm. It's always going to be that way now.
I think that's a new norm. I think people need to have a better understanding of their living expenses. They need to know where their money's going. They need to understand their budget so that when they are submitting a loan application, they do know what they're spending on different categories and they can justify it.
And I guess that's probably fair and reasonable as well, because if you can't afford to have a mortgage, you probably shouldn't have one. And that's what the Royal Commission is getting at in terms of responsible lending, where if you just take a blanket approach on living expenses, some people live beyond their means, but if that's not represented in the loan application, that's when borrowers can find themselves in problems. But it is harder to get money also outside living expenses because of the way in which lenders now look at your serviceability. It's not that the interest rate's 4.4 or 4.5%. They're assessing you on a lot higher interest rates, aren't they?
Yeah, look, the assessment rates are quite high compared to the actual rates, but I think the assessment rates are fair based on where interest rates will go. I think more of the issues are around the different niches, and this is where it's really important to have a broker because there are so many lenders. On our lending panel, there's, over 30 lenders, and they've all got slightly different niches when it comes to some of these servicing things. So, I guess as a property investor, now with declared living expenses, there are many banks that are actually double dipping, where they're not only wanting you to declare your personal living expenses, but they're also wanting you to declare a separate item for your investment property related expenses, as well as taking that into consideration. They're still only allowing 80% of the rental income for your property when they assess servicing. Now, that's not every lender, but some lenders are doing that. So you need to be aware that that's going to obviously impact your capabilities with those particular lenders.
So just on that point, just sorry to interrupt you. So what you're saying is that a lender will look at your living expenses and then any expenses associated with holding your investment properties are also thrown in as part of the assessment, even though they shade the actual rent that you're receiving down at 80 or even less % on that. So
absolutely, yeah. There's some lenders definitely doing that at the moment. So that's obviously something to be aware of. I think, along that line of thought, there's also a lot of lenders have removed or reduced negative gearing from their servicing calculators, which means that previously we could, add back the negative gearing benefit that you were getting from your investment property to, have a better outcome. But obviously with that being reduced or removed, that's deteriorating borrowing capacity. And, it seems that there's a few lenders out there that have double standards. If they perceive that the rental income is more than the interest expense, then they will actually tax that at 100%, but they'll still only take 80% of the rental income for the purpose of servicing. So there's a bit of, double dipping here. I think lenders have probably taken it a little bit further than they need to, but they just are, I guess, reacting to the Royal Commission and ensuring that they've really tightened their screws in these areas to ensure that they're not, lending more than they should be.
Which is, I think it's prudent to be more conservative than less conservative. So it's not a bad situation, but, property investors are always looking to either run a leaner portfolio that generates better yield and therefore more cash in their back pocket, or a portfolio that's going to allow them to keep growing and acquiring property over time. So these serviceability changes or new assessment levels and the way in which they're addressing or looking at income generated through property, what is the sort of impact on your ability to borrow? I know it's got to depend on what your salary is or how you generate your income, but it's going to slow people down a lot.
Yeah. Well, I think all of these little things added together do have an impact, but I think the biggest impact is going to be from the living expenses because, just a family of 4, for example, under HEM, their living expenses would have been around, the low 30s. Realistically, maybe their living expenses are, 80,000, 85,000. So that's actually resulting in, say, a reduction in borrowing capacity of almost 40%. So that alone, just the living expenses increasing is actually what is going to have the biggest effect. These little things in relation to the double dipping with the, investment property expenses, the removal of negative gearing, that's just sort of shaving it slightly, but it's the living expenses that are going to have the biggest impact in terms of your borrowing capacity. So, what we're advising our clients to do in preparation for this is to, like I said, review their living expenses, see where they can make changes to how they're living. And, that's good money management practice anyway.
Yeah.
But also building cash buffers for themselves to ensure that they do have a little bit extra. And, when they are doing their calculations, I know that you talk about this on your podcast regularly, Phil, but it's important for them to be forecasting their repayments based on the higher interest rate and based on what's going to happen in the future rather than just looking at the interest-only repayment at the, the 4% that they're getting currently.
Well, on that note, and going back to media as well, some people are picking up on this, and I don't think a lot of people really understand it. This sort of interest-only cliff, I think some people are calling it, where a lot of property investors use interest-only loans, which means that you don't ever touch the principal component of the loan. You're just servicing the debt and holding it.
Yeah, and I'm certainly guilty of that. As most property investors are.
I wouldn't say guilty of it. It's a strategy,
it's
really,
a strategy,
which makes sense when markets are going up, right?
Yeah, exactly.
It completely changes if markets are in decline, and depending where you enter that market, whether you entered it, recently and prices are going down, it becomes a bit of a problem. If you entered some time ago, it's and you can hold the property, it's not really an issue. But as part of these new greater oversight into how lenders are channeling money through to investors, previously when your interest-only period, which might have been 3 years or 5 years, come to an end, they just rolled it over and you just go straight into an interest-only loan again rather than going to principal and interest. But now it's going to be a lot harder to extend your interest-only periods, and that's going to be a huge impact on people because, if you've got to start paying principal, depending on big the loan is, it can impact up to sort of 40% increase in your loan repayments, and that's a big issue for people.
That's really true. There is a lot of I foresee that to be a bit of an issue moving forward, in that there are going to be a lot of people in a position that can't extend their interest-only period, because to extend it now requires a full reassessment based on these new borrowing rules. So, they may not even be able to, if they actually applied, they may not even be able to afford the debt they've currently got to be able to refinance. So I think the biggest issue is not for those people that have just had an interest-only loan for 5 years and a loan term of 30 years. When they revert to P&I, they're going to pay off their loan over a 25-year term. That's probably an acceptable jump.
Yeah.
The investors that are going to really get hurt are those that have perhaps already rolled over their interest-only period a few times. Perhaps they got a 30-year loan term and they initially got a 5 or 10-year interest-only period, because, back when I started investing, you could even get 15-year interest-only terms.
Yeah.
As you come to the end of that and then you have to repay the entire principal over a 15-year term, you're talking about the repayments doubling, and that's going to obviously have a massive impact on your cash flow. And as you know, cash flow is everything when you've got an investment property portfolio. So, we're definitely recommending to our clients and the people that we meet is to be proactive around this. Don't wait for 6 months before your interest-only period extends. If you can see that you've got some interest-only on your book and that's going to be expiring over the next sort of 2 to 3 to 5 years, talk to your broker now to make a plan.
So what can a broker do about that?
Well, I think it's a matter of having a look at their servicing capacity at the current present time. And if they're in a position to do something about it now, then I encourage them to do something about it now. So we could refinance the loans to new 30-year loan terms, or we can bring forward the P&I repayments, which would bring forward the burden to some extent, but reduce the burden to some extent, because the repayments will be lower because the P&I will be paid over a longer period of time. And I guess, if you're self-employed, for example, it means that you can plan, what your financials are possibly going to look like over the next few years to ensure that you've got a year where you can have strong borrowing capacity to refinance your loans at that particular point in time. So it's just about making a strategy that's right for you. It might be that the way moving forward is that you really do need to buckle down on your living expenses for 12 months just to get them down as low as you can get them down, so that you're in an ability to refinance so that you can afford the loans moving forward.
Yeah, I think the problem with living expenses is that people get so used to living at a particular sort of budget to actually start shaving back your budget. For most people, it's very, very difficult to do so.
Look, it is difficult, but if the alternative is losing all your properties, then you will take action, I think. So, if you can't afford to hold the property and you're going to lose, you're going to have to sell it, then you might be willing to take some action that's necessary. And that's pretty extreme, that might not necessarily be necessary, but it's a matter of just being proactive with it and planning in advance of the interest only expiring.
And is every lender as rigid as each other, or some are more flexible when it comes to this sort of stuff?
Well, at the moment, across the board with every lender, you'd need to go through a full credit assessment for having an interest only loan or reverting to an interest only loan or extending an interest only period. So it's, in terms of are some lenders different than others, it really comes back to the policy niches in relation to how they factor in servicing, and that is what differentiates them, rather than, what information you have to provide them, or do they have to do a full assessment, because they're all doing full assessments at the moment.
And the people that you work with as a mortgage broker, are they primarily investors or owner occupiers? Yeah,
primarily investors.
Okay, and would you say that most of your clients are across the state of play in lending right now, or most of them are
we've taken significant action to keep them informed and gone out to everyone that's on interest only and encourage them to review their loans. So we're going through the process right now with every one of our clients that's on interest only, and foreseeing the ones that are going to have problems. You know, there's quite a big percentage of them that will be absolutely fine.
Do you reckon most will be okay?
I think most will be okay. I think it's estimated that about 20% of people on interest only right now are going to have issues in terms of renegotiating their interest only and renegotiating their loans. 20% is still a big chunk, and I think what we're going to see moving forward is potentially a shift to investment properties with a higher rental yield because cash flow is going to be an issue, you know, especially as more and more investors have to pay principal and interest on their repayments. You know, they're going to need better yields to be able to afford to hold those properties because the cash out of pocket will hurt them. So I think we're going to see, you know, investors start shifting towards properties that are giving them higher yields.
Yeah, and this is just natural market dynamics, and it happens in all cycles. There's less investors in the market, and a lot of the intervention on behalf of the regulatory bodies was in relation to try and curb the rapid price growth of properties in Sydney and Melbourne. And it was thought, whether rightly or wrongly, that property investors were the biggest culprits for pushing up prices in property and therefore pricing out owner-occupiers. So, you know, these mechanisms come in place to try and curb investor buying, and it's taken a lot of investors out of the market. You're looking at some parts of Sydney and Melbourne, there was huge amount of investor activity. 40-50% of properties in some suburbs are owned by investors, which means there was huge amounts of properties available for rent, which put negative pressure on rents, and therefore the yields for investors went down. Now, with less investors in the market, you would think, and you know, natural market dynamics is that you're going to get greater owner occupiers in particular suburbs, therefore less rental properties, therefore putting a premium on rentals, which should drive up rents.
Yeah, exactly. I actually think that the changes are just going to make the rich richer and the poor poorer, to be honest, you know, because the people that are in a you know, have good portfolios and have good cash buffer and have already, you know, made substantial wealth through property, they're actually going to be fine. You know, it's the first home buyers or the, you know, it's the first time investors, you know, that just want to get their foot in the door. It's going to be harder for them.
They're probably going to hurt the most.
You know, they're the ones that are going to hurt. So, you know, I think that, you know, ultimately these changes are just going to benefit the people that are in a strong financial position and, you know, impact the people that are in a weaker financial position, which really ultimately is who the government should be trying to help. You know, they should be trying to encourage everyone to take their future into their own hands and to, you know, build a property portfolio that will support their retirement rather than having to have a reliance on the government pension or superannuation.
It's so complicated. Like, there's so many different moving parts because, you know, these mechanisms about changing the ability for investors to secure money by putting greater oversight on the banks to look at the sort of the fiscal capability of someone to hold a debt. It's meant that average Australians probably won't get into the market. So it's completely the opposite of what the government's tried to do.
Yeah, which will mean there'll be more tenants.
More tenants.
Which mean there'll be more.
You know, and first-home buyers have increased. You know, the percentage of first-home buyers in the market compared to what they were 5 years ago is a lot higher.
Yeah.
I can't remember exactly. So it's probably 80 to 90% right now, which is probably on the high side compared to what it was when there was a sort of a heap of investor activity sort of 3-4 years ago. So the challenge that you have is that more first-time buyers are entering the market, and whether they're first-time investors or first-time buyers, they're first-time buyers. But a lot of these guys have bought at the top of the market. And now if markets go down, a lot of these guys are going to be in negative equity. So
which will be hard.
There's a huge responsibility on behalf of the government to get this right. Yeah.
But I also think that, you know, whilst we might have seen a dip in investors in the market at the moment because of the change of rules, you know, we will hit a new norm. And once we do hit that new norm, I think it will all stabilise again. You know, investors just need to understand what the new rules are, and they need to work their finances and their property plans around that. So, you know, I don't think investors are going away. You know, there's always going to be a good amount of investors in Australia, and it's just that I think the change of policies, the Royal Commission is probably scaring a few people off right now.
Yeah.
And it's probably holding a few investors back that could actually do something. But once it all settles down and we reach a new level of normality, which hopefully in the next 12 months we'll get there, you know, hopefully some of them will have the confidence to come back in.
Well, the thing is that, you know, depending who you listen to, you would assume that don't invest in property right now because it's stuffed, right? You know, a lot of people are going to be scared of this market. My view is that this market presents a lot of opportunities and probably generational opportunities for people to actually, if they're buying the right stuff, to to actually use this as a real good building block to leverage into property and start building a portfolio. So it's not all bad. It's not all doom and gloom.
I actually think it's a fantastic opportunity for investors that are well placed to take advantage of the opportunities. And that's why I'm stressing, that it might be worth making some tweaks on your living expenses. It might be worth making some tweaks on, your financial position and where you're at, to ensure that you are ready to capitalise on the opportunities that are going to be presented to you in the next 12 to 18 months, because there will be opportunities. And I think, at every stage of the cycle, regardless of what's happening in the economy, there's always great buying opportunities. So it's just a matter of making sure that you're well positioned to take advantage of them when they present themselves.
Yeah. And, it's an age-old question, when's the right time to buy property? The right time to buy property is when you can afford to buy property.
Yeah, absolutely. And I think, more and more, I'm a big believer that you should never buy something that you can't afford to keep forever. And more that's going to be more important. Cash flow is essential, and you need to understand the cash flow of a property. So, and now investors are just going to take into consideration the principal repayments when they calculate cash flow. Whereas previously they might have only thought of taking into account the interest-only repayments in calculating cash flow. But, we're starting to see more and more investors choosing P&I, principal and interest, from the outset.
Yeah, and there's nothing wrong with that.
And there's nothing wrong with that, because they're getting a much cheaper interest rate.
Yeah.
We're able to negotiate much better discounts with the lenders, and they're not going to have this happen to them where, at some point in time their repayments are going to increase substantially. So, it's just a matter of working with the new rules, understanding the new rules, working with them, and preparing yourself for, putting yourself in the best position so that you can take advantage of the opportunities.
And it's a really important point. I recommend you speak to your broker or whoever your financer is. Have a look at what an interest-only loan is versus a principal interest loan, because you can get, upwards of a % plus difference in the rate you pay. So when you actually do the math, it might be plus or minus $20, $30, $40, $50 a month difference between having a P&I and an interest-only rate. So just don't get stuck on the interest-only.
And we definitely, as brokers, we have negotiating ability with the lenders further than, the advertised rates. So we actually have the ability to negotiate a bit harder if the investor's happy to go for P&I. So, it's definitely something worth considering, especially if you're refinancing your loans that are about to come off interest-only. Instead of refinancing them on an interest-only period again, consider a 30-year P&I term if you can, and that will sort of smooth out your cash flow.
Can you still get a P&I loan as an investor sort of under 4% or like?
Yeah, absolutely.
They're out there, because if you're interest-only as an investor, you could be sort of 5.2, 5.3% and upwards from there, right? Depending on what you're doing.
We're getting a lot lower than that, but there is a difference, definitely. So, we're seeing, you can still get sub 4 if you're willing to go P&I. If you're interest-only, it will be in the 4s, but definitely there is an advantage. And it's just about doing your sums, like you said, Phil. It's about sort of calculating what would it cost you on P&I, what would it cost you on interest-only, what's the real difference here. Can you afford to keep it if it's P&I? Can you afford the out-of-pocket cost? And if you can, then that makes some, possibly makes some good sense moving forward. But you got to take into account everything. What's your ratio of good debt to bad debt? What's your plan personally and from a property investment perspective moving forward? There's lots of considerations. So I think it's just a matter of, ensuring that you're getting the right advice that's right for you, and ensuring that you're being really proactive about managing your finances, managing your debt structure and your property portfolio moving forward. So hopefully with these changes in rules, it just encourages people to get more in tune with their money management, more in tune with their property investment management, and helps them to have more control over what's actually happening and set themselves up for success in the future.
What's your plan? You're a property investor, Marissa. You buying stuff at the moment?
Yeah, so I've been investing for almost a couple of decades now. I started when I was 18, and I'm a big buy and hold advocate, so I like to buy things and keep them forever. And my strategy has traditionally revolved around buying properties that I can add value to. So I'm now in a process where I'm actually going back and doing a lot of subdividing and developing of blocks that I bought 8 to 10 years ago. So currently working on building 6 at the moment, so on sites that I already had. And I think that as an investor with a buy and hold strategy, you go through different stages. You know, you've got your acquisition stage where you're aggressively buying and buying and buying. Then you've got your development stage where I think you're adding value to your properties and seeing how you can increase your rental yield and seeing how you can increase the value and manufacture some of your own equity growth. Then you get to a consolidation stage and an enjoyment stage where you're sort of starting to reduce your LVRs to get to a point where you can just live off the portfolio. So because I started almost 2 decades ago, I've had the time in the market, which has really helped me. Plus, I've done a lot of value add myself to my portfolio. So I'm probably at the consolidation stage now. Still a little bit of development. So there's still a few properties that I really want to maximise the value out of. But definitely, yeah, still really active in the market.
What's your end game? Are you going to retire with $1 billion in the bank, or you've got some nice number that you have that's going to been a nice retirement for you? What's it look like?
Well, my property portfolio has been quite successful, so I'm probably in a position now where I could just live off the income.
Yeah.
But I really love what I do, so I'm not the sort of person that would want to stop what I'm doing. I really love the fact that we can now help other people to do what I've done and what other property investors that we've looked after have done. So for me, it's building a passive income and leaving a legacy and being able to help my children when they grow up and basically having choices. You know, having the ability and the freedom to make choices about the lifestyle that we live and when and how we retire. If I ever decide to retire, I do love working. I'm a little bit addicted to it.
That's okay.
Yeah.
Are your kids going to end up with some huge property portfolio? What are you going to do with that?
Yeah, they will actually.
Yeah. Is that a good thing or a bad thing?
Look, I think that it's important that I teach them to appreciate what will come to them and I want them to not take it for granted. So, you know, that's just something that I'll get them involved in from a very young age. And I think
how old are your kids?
6 and 8.
Okay.
So they're already on a money jar system.
So do they get sort of earning money, what money does? You know, do you spend sort of time educating them on it?
Yeah, absolutely.
So I think about this a lot with our kids. So
yeah. Look, I'm really passionate about financial literacy in Australia, and we actually run a volunteer program called Rise High Rookies where we go around to schools and teach kids about money. So definitely I'm on this issue with my own kids, and we have a bit of a money jar system at home where they can earn dollars.
They earn dollars or cents? Dollars, do
Just
they?
$1.
Okay.
Yeah, they earn $1 at a time. I figured that was an
currency
easy...
is 50 cents at home.
Okay.
So, yeah.
See, I actually figured that $1 was an easy counting, easier for them to count and to understand. And what I did was I got plastic jars and I went on the toy websites and said, you can choose anything you want. And then we chose the toys they wanted and I stuck them on the jars to the level of how many dollars it would take to reach that. So if it was something $20, I sort of worked out, you know, what level on the jar would be $20. And then they knew that anything that the dollars were touching, they could afford. So it's actually been great. Definitely, I think it's something that they just have to keep learning and you need to keep reinforcing. I think in today's world of digital money, it's really hard for children to learn the value of money because they don't see it.
You've got to be able to see it and feel it. It's, how do they make their money?
So they have to do, I've got a money chart at home. They have to do particular chores, or I also like to reward them for certain personality characteristics or, so my daughter's a little bit shyer, so I try and reward her with $1 every time she steps out of her comfort zone and does something really brave.
That's cool.
If my son does something really kind, then, they might get $1 for showing an act of kindness. So it's, some of them are chores, some of them are, just being really helpful or really kind. And, they've evolved over time, what I give them dollars for. So we sort of sit down and review it every 6 months with them. And I say, okay, what do you think you should do to earn $1? And we write up a chart of the sort of things that they can do to earn $1 and we sort of go from there. The great thing is that I'm teaching them the difference between needs and wants. So they know that, mummy and daddy buy everything that we need and anything that they want, they need to buy with their money. So, that's an important lesson that I think that every Australian needs to learn.
Yeah, I agree then. I guess it's a nice way to sort of finish up the podcast. We've gone full circle in that it's harder for investors to get money because of the serviceability requirements and how they're looking at household spending. So I think a lot of Australians don't actually know how much money they spend every single month or every single week and how they go about doing that. And my view is that smart money education starts at home. It's the responsibility of parents to make sure that they teach their kids about the value of money and how to manage it properly. So
the hard thing is that a lot of adults don't know how to manage their money, Phil.
Yeah.
So, that's the challenge.
So some of the people I speak to on this podcast, I can't believe how they get through life, not knowing how they are spending their money, why they're spending it, where the value it lies. But everyone's wired differently, and that's the difference between a good investor and a bad investor in many ways.
Well, I think that the people that are across that and that are really careful with how they spend their money and understand where they're spending the money and spending their money is based on their values are the people that are going to succeed moving forward in property investments.
Yeah.
So, that's the opportunity here. The opportunity is to get across that, take control of it, and you will be well positioned moving forward to take advantage of opportunities. But if you just let it go and not worry about it, then you probably will miss out.
Yeah. Invest in financial literacy, whether it's yourself or your kids, because you'll be setting yourself up for a much better life.
Absolutely. I completely agree.
It's really good, Marissa. So thanks for coming in. I really enjoyed the chat.
Thank you.
Stay in touch. I've really enjoyed it. It's there's lots going on at the moment, and I think the important thing is outside of financial literacy that you've got to know your numbers. You've got to know where you are right now if you want to look at capitalising on this market. And this market's a very broad term. There's thousands of markets across Australia, but a state of flux in lending, borrowing, and market dynamics. Know your numbers, and it's probably worth speaking to a good broker if you're not really too sure about what you're doing. So keep in touch. Let us know when you're back in town. You're from Adelaide.
Yeah.
Okay.
Yeah. So probably in Sydney couple of times a year.
Okay.
Yeah.
We'll make sure we tee something up. So if you've got any questions at all, any views or observations around today's podcast, you can email the team, editor@smartpropertyinvestment.com.au, and any questions in particular from Marissa, I'm happy to flick them over to her. Remember, brand new website, it's coming. Watch this space. We'll let you know when it's there. Make sure you are subscribed so you're the first to know what's going on, and you can be the first to appreciate this great amount of work that our team here has put together. And we're going to be sharing our portfolio. It's going to be a big key part of the new website, plus all the other stuff I spoke about beforehand. Those reviews, please keep them coming on iTunes. We really do appreciate them. The team here get a real kick out of knowing that we are making a difference in helping you make more informed investment decisions. And that's what we're all about. I think we all can collectively as a community support each other to make sure that we could all become better investors, and just discussing some of the topics and issues today, can help everyone. And, there's some terms there, or there might be some concepts that you might not be familiar with. If you need any information about that, look, we write about it all the time. Go and check it out, smartpropertyinvestment.com.au, or you can email the team and we'll help you out where we can. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.